Welcome into the Invest Well Show. I'm your host, Michael Wall. Hey, listen, just wanted to share a few quick ideas on our weekly show that's really kind of giving you ideas and tips on what's happening in markets. A little side note here, this is political, so stay in your seats for a minute. I read an article here on CNBC that said Trump, Georgia prosecutor admits romantic relationship with the Atlanta DA. So the prosecutor has a romantic relationship with the district attorney. That's probably not important in the whole process, is it? Maybe it is. Kidding, of course. Hey, listen, so it's so important when we look at investments, and that's why I want to take a few minutes just to talk about some of the things that's happened over the last couple days and week, if you will. We saw a couple things. So first of all, Powell, the Fed chair, came out and essentially said that he is not planning on lowering rates in March. Not a great chance, strong chance of that. That's at least the sentiment thus far. So that means more of the same when it comes to the overall economy. You know, it's interesting when you look at stocks and investments, you might be out there and saying, okay, I'm investing here, I'm investing there. You know, if you've watched me over the years, I talk a lot about the idea of off-market opportunity, direct real estate, private equity, all kinds of other things. And by the way, there's good and bad of all of those. But what's so interesting when you look at investing in general on market, on equities and stocks in particular, is just how they respond from time to time. You know, here we are now, February 2nd, where Apple actually has released their vision goggles, if you will, or glasses, whatever you want to call it, that allows people to be able to do a lot of AI stuff in their eye set. And they actually outperformed on earnings as well. They actually did really, really well on earnings. And so what's crazy is Apple did well on earnings. They got this new exciting thing coming out, whether people like it or not, and the stock dropped. After earnings, after hours, and then even in the morning a little bit. It's kind of interesting. And then you have the flip side. You got Meta that actually also outperformed in their earnings, quarterly earnings, and their stock went up almost 20%. So when you take a look at some of these things, sometimes, you know, it goes back to the old song and statement that says, things that make you go, remember that? It really is the case. And so when you look at your overall investing plan, I just wanted to give you a quick thought this week heading into the weekend, and that is this. Make sure that you are investing in a way that you are well diversified. If you have some significant wealth, my strong suggestion is that you're on and off market. Now, obviously, you got to look at your own situation to determine what's appropriate there and what's right. But that's something you want to think about. Be well diversified. Number two, be thinking about investing into companies that actually have real staying power. You know, a lot of times people have thought, well, I'll invest in this company like a Google or something else like that because it's just not going anywhere. I got to tell you, if you look at the bellwethers, the big companies, companies that actually move markets in big ways, and you take a look at what those companies were 20, 30 years ago, go do some research. You will be surprised to find that the major companies that exist today on the market are not the major companies that existed on the market 20 and 30 years ago. What does that tell us? Well, it tells us that things change and things shift. It also tells us that there's life cycles for everything. What is relevant today may not be relevant tomorrow. And so when we invest, my challenge as you think about your investments, especially if you're investing on the market, on the stock market, my challenge is to be thinking about it through the lens of being more, we'll call it shorter term than longer term when it comes to investing. Now, when I say shorter term, I'm not talking about day trading. I'm not talking about every month or every 2 months or 3 months. I'm talking about the idea of maybe a year to 3 year horizon or 3 year to 5 year horizon. This idea that a stock is a great investment for 10, 15, 20 years has just changed in a lot of ways. And one of the reasons that's changed is because of the technology that exists today. We have so many new ideas and things that come out on the regular that it's so easy for a smaller, younger, more robust company that has the agility to move quickly. It's interesting how those companies can kind of take over significant market space pretty fast. Why? Well, because they're nimble. A larger company, similar to like turning an aircraft carrier versus a speedboat, right? That's kind of the analogy. A larger company is much larger. They have more regulation. They might be in a situation where they have more thought and ideas. They have more just things happening on the daily. And so it's harder for them to make shifts. Now, obviously, one of the things larger companies will do oftentimes is buy other smaller companies that are kind of shooting up. But it's important to think about when you look at investing. You know, when I look at real estate as an example, I think about it the same way. Money doesn't go away, it just moves. And one of the things that we know as we look back over years and years and years, we know that years ago, CCRCs, continuing care retirement communities, were a great resource as an investment because we had an aging population. We had the baby boomers that were getting older. We had a situation where there was more need for care. Continuing care retirement communities were a hot commodity as far as investing into. And then what happens over time is you have what's called oversaturation. Everybody decides it's a hot commodity, and then all of a sudden, that particular investment is being done by a lot of people. And at some point in time, you have oversaturation, and it's time to get out. Similarly, with investments, you'll see a lot of times certain stocks. Tesla was one of them. Apple's another, where you'll see a lot of ETFs or even institutional mutual funds that one of their top 10 or top 5 holdings is the same stock. So even though you might think you're diversifying in different funds and diversifying in different indices and diversifying in different mutual funds, you may not necessarily be that diversified when you actually look at the depths of what is actually owned by the fund. So I want you to think about that as far as oversaturation. There's always opportunity. That is the key. You just want to make sure that when you're looking at your investments, when you're looking at what's happening, and when you're looking at where you're putting your wealth, you are diversified in such a way that it actually helps complement this investment, complements this investment. And now you're in a place where your investments literally are working for you and complementary for you instead of opposed to each other. Be thinking about that on the journey as you invest. Listen, have a great weekend, great time with your family. I'll connect with you next week to share some more insight and thoughts on what's happening in the investment space. Hey, be blessed. Have a good one.